from the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Wednesday the 29th, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson. Alix Steel, of course, over in New York. Welcome, everybody, to Bloomberg Markets. Alix, this market has something of the former feline about it. Maybe there are dead cats out there. Maybe they're made of rubber.
Maybe they're bouncing. Now, I know that the skeptics out there are going to say, Alix, you can't have dead cats bouncing because you didn't have a good 5% drawdown within the S&P at least. But I would argue you had that 2% yesterday, and we've had a lot of dip buying in general over this cycle. So to expect that 5% dip may be somewhat unrealistic. So I'm going to go with, are the dead cats actually bouncing? You have all the S&P sectors, with the exception of energy, are up today, up 0.6% for the S&P. Tech, which got beaten down really hard yesterday, nicely rebounding by about 1%. But we haven't made up the losses that we saw yesterday as well. So watch that space. Yields getting a little bit of pressure to the downside, but just down 2 basis points. We've had a tremendous run in just the last 10 days alone for the yield. So 150 is still pretty strong. That does definitely put pressure, say, on earnings, for example, and growth for tech. I just want to highlight, this is for you, Guy, sterling getting hit yet again. There's questions as to why specifically sterling is getting hit. The cable rate down another 0.6%. We haven't seen this since back in like January, December of 2020.
Yeah, I think, to be honest, there was probably a little bit too much exuberance maybe around what the Bank of England did a few days back.
True.
Now we've got this kind of inflation crisis that we're dealing with. Maybe we're just taking some of this back. But the move has been swift, definitely. The data are so important at the moment, and trying to kind of get the signal out of the noise, I think, is critical. The data generally have been kind of heading down versus the expectations, so we've been underperforming. We're starting to get maybe some data that is outperforming. Pending home sales hitting the tape right now. The month-on-month number coming through at 8.1. The prior number was negative 1.8. That has been revised down to -2. The survey was 1.4. So this is a significant beat in the housing market. In terms of the year-on-year, this is the non-seasonally adjusted number, -6.3, but still the survey, -13.8. So maybe signs of better data. There's an interesting story, actually, that we were chatting kind of in the newsroom today, Alix, talking about the idea, and it's a similar story over here in the UK. First-time buyers increasingly squeezed.
Yep, because they can't afford to do something like really quickly or cash down or pay full or go into a bidding war. Then they go into the rental market. They make the rental market more expensive, and then it kind of has that feed through. Okay, so that's the data picture. There's also a lot of other top stories that we're following today. So let's get right to it. Abigail Doolittle is watching the market technicals. Bloomberg's Anne-Marie Herdern's on the Hill about the debt limit. And Bloomberg's Helen Robertson is keeping her eye on the fuel shortage over in the UK. Want to begin with the market technicals. It's been a very difficult couple days. Abigail, dead cats bouncing or no?
Well, Alix, it's hard to say, but it certainly has been a couple of difficult days. Lots of volatility and choppy action. And we can see this truly with the Russell 2000. These are the last 3 days for the Russell 2000. So you can see that earlier this week there had actually been a big up day when the reopening reflation day trade was hot as yields were rising. That, of course, hit tech a little bit on Monday. But then yesterday, the Russell 2000, that reflation trade, reopening trade, selling off at least relative to small cap. Today, a little bit of a recovery, but net down 0.5%. So we don't really have a bounce here yet on the week, at least for small cap. Now, relative to big cap, if we go into the Bloomberg terminal and take a look at what's happening for the S&P 500, a very important technical test, one that happened about a year ago when you had the S&P 500 go below its 50-day moving average, hit the 100-day moving average, bounce off, and then retest. That proved to be a successful test right into this year's rally. Well, this year we have something very similar, not so long ago, below that 50-day moving average, the near-term buyers out, the 100-day moving average holding back up, and then another gap below that 50-day moving average yesterday, that 100-day moving average holding again. But it's often said that you buy the first test, not the second. That wasn't true last year, but there's something about this action here, especially as yields are continuing to move around, Guy, that suggests more volatility probably ahead for stocks.
Abigail, thank you very much indeed. Yep, some of that volatility emanating from what is happening in D.C. President Biden cancelled a trip to Chicago today to focus on lobbying lawmakers to move his agenda forward. Treasury Secretary Janet Yellen warning yesterday of catastrophe if the U.S. fails to raise the debt ceiling. She did that when she was facing the Senate Banking Committee. This is what she had to say.
It is imperative that Congress address the debt limit. If not, our current estimate is that Treasury will likely exhaust its extraordinary measures by October 18th. America would default for the first time in history. The full faith and credit of the United States would be impaired, and our country would likely face a financial crisis and economic recession as a result.
So the 18th, that sounds like it's set in stone, doesn't it? My question is it? Dates in D.C. tend to be a movable feast. Let's go to Washington now. Our correspondent Anne-Marie Jourdain standing by for us from the Capitol. Anne-Marie, let's talk about that. The Treasury Secretary saying the 18th is the cutoff date. We have to get it fixed by then. Is it really the 18th?
Well, there's a little bit of flexibility there. The real fact is, Guy, they just don't know. So this is Treasury Secretary Yellen's best bet in terms of when the Treasury would have to potentially default because they've been running out of cash. We do know that it was going to be sometime in the middle of October, November. Bloomberg Intelligence thought it was maybe pushing back a little bit in October, but it is somewhere in the middle of October, and Yellen has come out with this kind of line in the sand, but that really gets it going here in Congress. But what they need to do to make sure that they shore this up before that October 18th date that she set forward in this letter to congressional leaders as well as publicly in her statements. So what comes now is going to be very much a game of chicken, because Republicans continuously insist that the Democrats need to do it alone, but the Democrats are saying and urging Republicans to do this in a bipartisan fashion. If someone is going to capitulate, the Democrats are the ones that could do it by themselves through reconciliation. If they were to do that, they need to get that process started quickly, because it take about 2 weeks. That just leaves you with a few days to that October 18th deadline.
Yep, that'll really cheer the market up to know that it's going to be that tight. AMH, thank you very much indeed. Anne-Marie Jourdain joining us from D.C. So, Alex, my wife has told me that when I get home tonight, my job is to get in the car and drive around the area looking for fuel. Basically, we're getting close to running out. School runs have to be done. Things have to be sorted. So that's the job for me tonight. The question I have to ask is, am I going to find any?
Are you? What do you think? See, you should have filled it up on Saturday.
I know. I drove past. Silly of me. I drove past an empty petrol station. I had the opportunity. But what we've heard today is that the Prime Minister is basically bringing in the reserve team. We are going to be seeing the Army helping out. We've got a reserve tanker fleet that apparently is going to be brought into action. Is that going to alleviate the situation? Bloomberg's energy and commodities reporter Helen Robinson joining us now. Am I going to find any fuel tonight?
Hi there. Yes, I mean, what we've been hearing is that the supply situation is much better than it was even just a few days ago. I mean, obviously, at the height of the crisis, about half of the UK's retail sort of petrol, as we call gasoline stations, were basically struggling to supply users. Over the past few days, obviously, we've seen just really long queues, and even, you know, sort of essential services vehicles, so ambulances, for example, just queuing up, unable to refuel. Obviously, as you mentioned, the government today has put this measure in place, saying that the reserve fleets will be activated and that the Army will be made available with a select number of drivers within a few days.
I mean, those pictures are really unbelievable. They look like the pictures that you saw here in the 70s. The difference is it might be a short-term bottleneck. We also heard that over in China, they're going to consider letting power prices rise in order to combat the kind of fuel usage. And the idea is going to be a real supply and demand price setter now. This is a power problem. Logistics are one thing, but there is a real power crunch globally.
Yes, absolutely. And obviously, you know, commodities and energy-wise, anything that happens in China has a direct relation, you know, to the rest of the world. So obviously what's happening in China, as you mentioned, is that they're trying to curb power use because basically they can't get enough coal, essentially. And that has a direct impact on other countries' abilities to get coal. And obviously what we know is happening at the moment is that gas prices all over the globe are at absolutely record levels. So what we're seeing across various different energy markets is a real supply squeeze.
All right, Helen, thanks a lot. Really appreciate it. Bloomberg's Helen Robertson joining us there. All right, well, coming up, how does all of that wind up affecting earnings? Well, our next guest says equity markets may not be able to withstand the pressure from inflation. Katie Kaminsky, Alpha Simplex Chief Research Strategist, will be joining us next. This is Bloomberg.
Inflation is elevated and will likely remain so in coming months before moderating.
Clearly, inflation this year is going to be above 2%.
We are seeing upward pressure on prices, particularly due to supply bottlenecks in some sectors.
We are seeing monthly inflation rates taper off.
Yes, ma'am. What do you think it'll be at the end of the year, if not 2%?
Probably closer to 4%.
These effects have been larger and longer lasting than anticipated, but they will abate. And as they do, inflation is expected to drop back toward our longer run 2% goal.
That was Fed Chair Jay Powell and Treasury Secretary Janet Yellen yesterday at the Senate Banking Committee talking about inflation. So now the question becomes, how does this feed through to the earnings picture? So far, we've seen some pass through in terms of cost where you can raise your prices, but how much more juice is left for those operating margins? So this is a great chart. The blue line shows earnings estimates for this year. The yellow line shows earnings estimates for next year, which really seems to be nicely tracking the S&P right now. The question is, are we going to see negative earnings revisions? We've already seen over in Europe more downgrades now than upgrades when it comes to earnings. And if you're factoring in that margin story, add in things like wages, not only just inflation, but freight costs, for example, and how much more do earnings have to come down? And Guy, the question is, how do you reprice for something like that?
Yeah, do you need to reprice? Are equities actually a decent hedge, though, against what is happening on the inflation side? Are they better, obviously, than bonds? Are they the asset that, in fact, you have to own? Katie Kaminsky, Alpha Simplex Group Chief Research Strategist and Portfolio Manager, joining us now to try and answer that question. Do you think equity... what do you make of yesterday's price action? Was it an inflation scare? And is that a sign of things to come?
Definitely. And we have to focus on what has been said. The key point is that inflation is much more persistent than anticipated. And when you think about that from that perspective, it means that when you look at market moves yesterday, this is what I was really interested in seeing, is that you saw equity markets down, you saw bond markets down, you saw gold down, you saw silver down, you saw the yen down, and you saw the Swiss franc. And frankly, that's not a typical move that we have when we have a big retraction in the S&P. We usually see the opposite in a lot of these cross-asset markets. And for me, that shows that this inflation problem is serious enough that it's going to have to push us towards a tightening or tapering environment where rising rates will eventually come. And so that whole combination is really a shift in regime. And yesterday's price action really showed that, and that we saw that the market was reacting to inflation despite some of the other noise.
So does that explain why the dollar was up? Because in that environment, if inflation is coming and asset classes are kind of reacting to that, why would I own the dollar unless it means we're going to see more rate hikes?
Of course, but there's also the issue that risk off tends to be also very favorable for the dollar as well. So we have to think about all the capital flows and other issues that will kind of complicate that issue. But I think in terms of the dollar yesterday, it was probably more of a risk off play, and that everything's selling off, and that's sort of the place to go. It was one of the only places to go, to be honest.
In terms of what you do with your money then, what do you do with your money?
Oh, that's a good question, because when you think about where you should invest in an environment where rising rates and inflation are an issue, you have to think about the problem from a very different perspective. So you need to sort of slow down and think, what is going to weather this type of environment a little bit better? So I would start first with thinking about rising rates. Rising rates are going to definitely have a very different tilt of what you see in the equities market. So you're going to definitely see favoring more cyclicals and value stocks, just because they will weather some of those changes as we see interest rates rise over the longer term. And in terms of inflation, it's also complicated. I think Alex brought this up earlier, is that there's many different factors that we have to watch, whether it's wage inflation or whether it's supply chain disruption that's going to be the potential effector of different companies. So I think it is very much still about thinking how inflation hits different assets and how that percolates down and at what rate into different sectors of the equity markets.
So the basic playbook is sell bonds, buy some equities, or is it sell both?
So I would say equities right now still look reasonable. There's still some good numbers for earnings. But for bonds, there's definitely some short signals that are starting to percolate. And that's been happening most of this year. And I think that's sort of what we're asking ourselves the question, if we're moving to a new secular trend in bonds where this great bond bull market finally ends and we finally have rising rates at some point, it's going to change the game for everybody.
All right, Katie, thanks a lot. We got to leave it there, but really good analysis from yesterday. Katie Kaminsky, Alpha Simplex Group, thank you very much. All right, coming up, in the midst of all of this, Warby Parker goes public through a direct listing. It will be the second direct listing so far this week. We're going to break down what that means, the trend, the performance with Stacey Cunningham, a New York Stock Exchange president, coming up next. This is Bloomberg. Sell-off yesterday did not freak out Warby Parker. The eyewear retailer starts trading today. We're waiting for those numbers. It's gone public through a direct listing. So I want to get more on that with Stacey Cunningham, a New York Stock Exchange president. Stacey, it's always good to talk. Let's talk about the kind of internet retail company landscape. We've seen 12 of those companies have gone public this year versus 9 from last year. The performance has been mixed. What's the pipeline? What's the trend? How are they performing?
Yeah, if you think about the IPO market more broadly, across the board, 2020 was a blockbuster year. We had more IPOs than more capital raised than in history. And then we saw 2021 already eclipsing those numbers. What's unique about this time and very different from what we talk about when we look back at the dot-com era is the breadth of types of companies. And so, as you mentioned, we're seeing internet tech, we're seeing consumer tech, we're seeing healthcare. There's so many different industries going public right now. As the markets have become a little choppier and we're seeing investors become more discerning about which companies they're supporting, the pipeline continues to be really, really strong. Some companies are choosing to wait a few quarters before they go public, but there's still a lot lined up in the short term. And we're excited to welcome Warby today here at the NYC via direct listing. They're also thinking about how they go public, not just when.
Stacey, I noticed you're wearing your glasses. I feel this is appropriate. Let's talk a little bit about the direct listing. You say the markets are getting a little choppier. Does the direct listing become more attractive in choppy markets? Do you think more companies will go down this route?
That's a great point. We're already seeing more and more companies considering a direct listing, but when you're not pricing shares and you're not selling shares into the market, you're a little less concerned about what the market conditions might be. You're allowing investors to price the company, but there aren't new shares being sold. And so it is attractive when markets might be a little bit more volatile. We are seeing more companies choose a direct listing, not just because of market conditions though, because of their priorities. So the cost of capital is significantly better in a direct listing because you're allowing the overall market to participate. And that democratization of access to that initial listing is a really big, important driver for many companies who want all investors to have a level playing field as they hit the public markets.
Hey, Stacey, I hear your point about direct listings, and so you're somewhat immune from the volatility within the markets in some capacity. But if we get the trajectory of like yields really rising and other assets really repricing for that, do you think that materially impacts the space?
You know, I think not so much for direct listings. It's just the capital markets attracting investors. And there are drivers for why there are so many companies looking to go public. If you rewind back to the spring of 2020, nobody would have expected that we would be in such a busy IPO calendar. But it was very expensive during that time in the early days of the pandemic to raise money in the private markets. And the public markets were providing access to capital to companies who needed it urgently, desperately, and they needed it really efficiently. And the public markets were really on display. So now we've seen a lot of companies recognizing the value of the public markets. Yes, certainly interest rates are playing a role in that as well. But there are companies that are looking to be public because they're not quite sure. I mean, we're coming off at a 10, 11-year bull run market where a lot of companies recognize the fact that conditions might not be within their control over a period of time, and they're looking to tap into that capital so they can continue to grow and expand their businesses despite conditions.
Stacey, we're starting to see some SPACs giving back money to investors. Do you think that is a sign maybe that peak SPAC is behind us?
I think peak SPAC is behind us. If you think about the days where we might have a busy day and there were 20 SPACs going public on a single day, I don't think we're going to get back to those levels. There's been a bit of a reset, which is healthy for the market. You're seeing high quality SPACs go to market. You're seeing high quality business combinations get done. But when there are already 400 plus SPACs out there looking for business combinations, I certainly don't think we're going to see an acceleration of those trends. And just like the rest of the market, investors are going to pick and choose the opportunities that they believe are going to deliver them the best returns.
Hey, let's get to the actual nuts and bolts of your business, Stacey. I'm wondering where you see growth right now in the trading business, or are there other areas that you need to be looking at?
There's certainly a lot of opportunity still within the capital markets as well as in the trading business. A lot of the conversations that Chair Gensler is having about the markets and the way they function today are good for exchanges. Just think about the way exchanges trade today with more than half of trading in many busy stocks occurring off of exchanges in markets that aren't transparent and don't provide price discovery the way an exchange does. There's a lot of focus from the regulators and others on bringing more transparency to our markets. That's good for the exchanges, since the exchanges are the ones that set prices. We're the only place where people are displaying their prices, which leads to a better result for investors. So moving markets and focusing on that fragmentation and addressing some of the drivers that are really keeping markets so fragmented today will be good and certainly an area of growth and opportunity. Another area of focus for us is ESG. Our companies and our investors are very focused on how they have, what impact they have in their day-to-day business and their investments long-term. So we work very closely with our listed company community, along with the investment community, on supporting initiatives around ESG. We recently announced a partnership with the Intrinsic Exchange Group to that goal also, to meet the needs of our customers as their focus has shifted.
Do you think we're now at the point where we're going to start getting a little more clarity on what is ESG and what isn't, what has been greenwashed and what hasn't? We're starting to see the rules getting tightened up. We're starting to understand maybe what the rules of the road really are. Stacey, how much of what is classified as ESG right now really is?
Yeah, it's a great point. I mean, if you look at the number of professionally managed assets in the U.S., $1 in $3 is invested in an ESG strategy, but not all ESG strategies are created equal. And so that's why we provide a lot of data behind what our company's doing. We collect data at ICE across 500 different ESG metrics that investors can use to inform their decisions and have real visibility into what companies are doing to drive the change that they want to see.
Stacey, the glasses look great. Thank you for joining us. Stacey Cunningham, New York Stock Exchange president. Really appreciate it. We're going to talk inflation. We're going to talk more about inflation and distressed debt. Bruce Richards, Marathon Asset Management, up next.
We would continue to add accommodation, not subtract it, until well into the middle of next year. And we think that's appropriate given the strength of the economy. The test for raising interest rates is substantially higher.
That was Fed Chair Jay Powell speaking yesterday about interest rates, really separating any kind of tapering from that interest rate hike. Nevertheless, though, higher rates seem to be in the cards. Inflation's still a worry. How do you price that in to different parts of the market? Well, Bruce Richards, Marathon Asset Management Chairman and CEO, joins us now. He has about $23 billion of capital under management. Bruce, I have to guess that this is the question that you're all talking about right now in your meetings. Like, how does inflation impact earnings and growth?
It starts with every morning meeting when we get together, the traders, the investment managers at Marathon, the analyst team, and we talk about the macro first before we dig in and talk about industries and company-specific news. And so when you talk about the macro and we talk about what we heard yesterday, we heard from the dangerous man. I'll take the other side of that. He's not a dangerous man. He's the man that should really be renominated for another term. And we believe he'll have the votes because we think it's really, truly nonpartisan. There are a couple senators that maybe have a very adamant view otherwise, but we believe he'll get the nod because Janet Yellen and we believe the cabinet is there and we believe the votes are there. So the first question then is tapering. The Fed buys every month, 120 billion, 80 billion in treasuries, 40 billion in mortgages. That equates to 1.44 trillion per year. So when they taper, and if they begin in November, December, they end by July of next year, then who's going to buy that additional $1.44 trillion in debt? And to underwrite that, does it take a higher interest rate to underwrite that? And the answer to that, I think, is all in inflation. And so if inflation is truly transitory, then I think it could be underwritten well at current rates. But if it proves to be less than transitory, and when does transitory become more permanent is the question, then I think it takes higher rates. And that is something the market hadn't been used to. There's an enormous amount of duration in the marketplace, more duration than has ever existed, more bonds that have ever existed, and investors in the marketplace aren't ready for these losses and higher rates of inflation. So the key here is inflation. And you see it throughout the system. Housing prices, we got the Case-Shiller just recently, yesterday, 19% year over year. You see what's happening in shipping prices. You see what's happening in food prices. You know what it's like to go into a restaurant here in New York City or any city where prices are up 20%. Labor costs are up, and these aren't transitory costs. These, we believe, are somewhat permanent costs.
Oh, yeah, okay, that's a massive issue for a lot of companies that are clinging on, Bruce. So let's talk about the default rates. If we do see these prices being as sticky as you say, do you think companies that are kind of at the margin, that have been supported by the huge amount of largesse that the dangerous man has delivered, do you think that they will be able to survive if we do see input costs rising for many of these businesses? These are the critical costs. You kind of pay your people too much, you're going out of business. Your suppliers charge you too much, you're going out of business. Where do we sit in terms of the default story associated with this inflation narrative?
Well, the default rate has dropped below 2%, and what you're going to see is going to be about 1%. So I wouldn't worry too much at this stage about defaults. Debt-to-EBITDA ratios for the high-yield market has fallen from about 5.3 times to around 4 and change right now, so they've improved. And as equity prices have rallied over the course of the last year or 2 years, the debt-to-enterprise value is also the best it's been in years. And so we believe, as fluid as the markets are, as much capital has been raised, and so you look at the high-yield market, there used to be X number of issuers a year. X was around 150 to 200, and now you have 400 issuers a year. In fact, this calendar year, we talked about the IPO market having record issuance. Also in the high-yield leveraged loan market, we'll have record issuance, including 75 new issuers. And in fact, I happen to be wearing my Warby Parkers right now. So congratulations to the company on their IPO in your last interview.
We didn't even know it was going to turn into an advertisement. So, okay, last time you were on, specifically we were talking about how you made some investments into the UK hospitality industry, and then a lot has happened since then, and they're actually getting hit more with Brexit issues, labor issues, and power issues. What's it like to do that business now? Would you be investing more? Do you regret the investment?
No, we like the investment. Hospitality is coming back. Our hotels are all improving from the basis which we bought it, and we're acquiring more. The big but, because there is always a big but in everything, is we have 1,800 employees across this enterprise, and we're short about 110 in terms of service. We've hired 325, and so hiring is very much of an issue. And Guy, you live in UK, and you see it. And you see it, throughout all pricing. You can talk about energy, for instance, and what the gas lines look like. Those gas lines is not because we have a shortage of energy, it's because you have a shortage of transportation. There's 18,000 less truckers that work in the UK today versus, pre-COVID, pre-Brexit. And so, when you have, natural gas and oil and gas coming, and that needs to be, going from the ports, to the stations or, to industry, to companies, that's a problem when you don't have the truckers that you once had. And part of that's Brexit, part of that's COVID.
What do you think the gap is between between supply and demand? How strong do you think demand is, and how big a gap is there? And is that gap getting wider on the supply side?
Yeah, the gap is getting wider on the supply side. The supply is a real issue, and the whole supply chain is what that question begs. And it starts with many different aspects, right? So it starts with shipping costs, and so off the port of Norfolk or Newark, it's a 10-day lag to get your ships to dock, to unload. In Long Beach, California, it's 14 days, and there's 70 ships sitting anchored off of Long Beach. And beyond those 70 ships, what you don't read about, there's another 14 right now that's sitting beyond the waters where you can actually drop an anchor because it's too far out. And so they're kind of just moving around and with the winds. And so, but once you get it to port, then you take the containers off, and then they sit there. And that's why you see that the rail car traffic is down 15% when it should be up 5% because we're moving so much merchandise. And so it's really problematic. You look at the chip shortage, you look at the labor shortage, you look at the prices that you see for all commodities, whether it's glass and steel and wood and materials and finished goods and appliances. And so you can see why housing prices are up, because the price of labor is up, the price of land is up, the price of everything that goes into constructing a home is up, including, you know, the plumbers, the electricians, but also the materials that go into the home.
Let's switch gears for just a second. Evergrande.
Evergrande.
Does that create opportunities for you, or does it freak you out?
Oh, absolutely opportunities. I mean,
okay.
You know,
Where? How?
You know, Evergrande, the big picture in Evergrande is it's a problem. It's a problem for China. It's a problem for its housing market. It's a problem for the banks that, and the whole, you know, segment that it kind of like relies on this, right? And so there's a lot of jobs related to this and a lot of commerce related to this, a lot of industry related to Evergrande. So number one, that's a problem. So here's the pecking order for all the folks that are thinking about Evergrande and think about the logic of how it's going to play out. Number one is the first obligation, when this gets restructured, when that day comes, and we think the can will be kicked down the road a bit, and there will be some coupons maybe to get paid in interim, but when it happens, and we don't know when it happens, the first pecking orders, they're going to make sure that the homeowner that bought those homes take delivery and that they're made whole. Second is the trade, the folks that, you know, did the work and that supplied the, you know, goods and services and you know, appliances to bathtubs to are going to get paid because they're owed a lot of money. Third, and this is very interesting, are the domestic creditors are going to get paid first. And then finally, at the very end of that pecking order are going to be the offshore bondholders, the dollar bonds that, you know, trade in New York law outside of China.
Okay.
And there's lots of that debt that's, you know, came in domiciled, New York law implied.
Right.
And so we're in the marketplace buying Evergrande debt, and we'll continue to buy it at these very low prices. And the whole question is the price of acquisition for the debt that you buy relative to what you think recovery value is. And we don't know what that recovery value is, but you're getting close to the point where we think it now makes sense for the first time. So we'd never bought the credit until just this week.
25 cents? I'm hearing 35 cents maybe.
25, 30. Sold to you, big guy.
Okay, but you so you'd be that's interesting. So
I
less
can't
than 25
talk about
cents
exact
on
entry points, but no, not 30 cents.
No, but I'm curious. I'm curious how if the capital structure looks like it's completely reversed. Like it would normally be completely the other way around.
Yes.
So basically, what you're saying is that the dollar holders are going to be last in line, and therefore the recovery rates are going to be significantly lower than you would normally expect.
It's completely unknown. What happens in China, what happens in Hong Kong, and this is Hong Kong based, is completely unknown variable, and what we have to watch first.
So, are there other opportunities that Evergrande is also creating? So if you're buying Evergrande debt,
well, they're selling down a lot of
point.
assets, right? So there's just, you know, monetized 1.55 billion, and that'll go to pay off a bank, and there's going to be other assets they sell, because in this holdco is a lot of assets, and that includes assets beyond just the property that they're delivering.
Are there any other developers, Bruce, in China that you think are also going to end up in the same position? Are you buying credit elsewhere?
Well, we think you wait for the domino to actually fall, and you see how bad it gets for others that aren't quite the problem that Evergrande is today. And so there I would be patient. Wouldn't want to be early. And there I would want, you know, proof of concept and, you know, this case study to play out before we would invest more.
We could definitely talk for the next 20 minutes, but we have to leave it there. But please come back. We would love to get more of an update.
Yeah.
Bruce, really good stuff. Bruce Richards, Marathon Asset Management Chairman and CEO. Thank you so much. Really appreciate your time. A quick update for you here on oil inventories. We actually saw a pretty solid build overall in inventories, coming up at about 4.5 million. Refinery utilization picking up, but you're seeing a build in inventory and also product inventory as well. This is Bloomberg.
This is Bloomberg Markets. I'm Rishka Gupta, and you're looking at a live shot of the principal room. Coming up, Austin Goldsby, the Chicago Booth School professor and former Council of Economic Advisors chairman. That's at 12:30 p.m. in New York. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. In Japan, Fumio Kishida is set to become the next prime minister. The former foreign minister won the leadership of the country's ruling party and is expected to be named to succeed outgoing Prime Minister Yoshihide Suga. Kishida has promised tens of trillions of yens in spending. He'll face an immediate test of his broader appeal in a general election that must be held by November. In the UK, the government's taking steps to ease the shortages that have triggered chaos at gas stations. A fleet of reserve fuel tankers is available today, and soldiers will be deployed within days to drive the trucks. A trade association says there's been a big drop in the number of stations without gas. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex?
So, Guy, are you going to get an EV now? Are you scared of the petrol lines here? Is this a transition?
Well, no, but I think a lot of people are talking about that. Time to make the switch. If there are long queues, I think there's a lot of smug people out there, aren't there? Driving past, whistling, which is something that you would struggle with, obviously, as they go past the petrol stations in their nice electric cars. Silently.
I can't whistle at all, and Guy knows this. I'm tone deaf with whistling. Yes, although I should make the point that there are so many players now in that field, and you wonder what the saturation point looks like. David Weston sat down with Jim Farley yesterday as the president and CEO of Ford and talked about how there's so many players. Like, how do you distinguish yourselves?
We're not talking about aspirations. We're doing it. We're on sale and sold out with the Mach-E and the F-150 Lightning, and the E-Trans is coming just in a couple months. We have iconic vehicles. We're betting on the good stuff. Electrified Mustangs, electrified F-Series, vans, are really emotional products. And we think that's going to be a big win.
All right, well, here's another player in the field. EV maker Lucid Motors is going to begin delivering its $169,000 sedan next month. Now, shares are jumping on the news. CEO Peter Rawlinson is here with us now. So, Peter, the big news also is that you're producing the car. Like, you're already there. Like, you're leapfrogging a lot of these guys. Talk to me about the demand you're expecting and what you're noticing.
Well, the cars are coming off the line right behind me, Alex. And we've just surpassed 13,000 pre-orders. We had a great event here yesterday. We opened the factory doors for the world to see, for valued first customers, for influencers, journalists, analysts, and a whole bunch of people, including our investors. And everyone was blown away with the progress that we're making. Cars are coming off the line, and we're scheduling customer deliveries in October.
Okay, October, November, December. How many customers are going to be in their cars driving around, Peter, by the end of the year? What is that number going to be?
Well, we're pushing to as hard as we can to satisfy as many as we possibly can. We're going to ramp production up significantly. But, what really matters right now is getting the quality right, not getting rushed into just driving numbers down the line, making sure that each customer receives a great quality product. And then we're on track to ramp up to 20,000 units next year with a target of 50,000 in 2023.
I think in your SPAC filing, Peter, I just want to kind of push you a little bit on this. You said 577. Is it plus or minus 577?
We're pushing like crazy as a management team to achieve the 577. We're giving it all we have to get there, and we'll be able to give you a much clearer indication of how achievable that is when we do our first earnings call for our third quarter, which will be mid-November.
The risk that the supply chain problems impact you on that?
Well, what has impacted us, and I've said this many times, is that we've been hit with the impact of COVID in our supply chain for quality of parts. And without quality parts, we simply can't build a world-class quality car. We're absolutely committed to that. So we have the aftermath of COVID to deal with for our supply chain, and it's really supply quality issues.
Peter, you talked about last night, which sounded great. You talked about having a Dream Drive event. I think that's going to take place on October the 12th.
That's right.
What is the Dream Drive event? What is Dream Drive going to be?
Well, Dream Drive is the name for our autonomous and ADAS system advanced driver assistance system. We have perhaps the most advanced system in the world today, with 32 sensors integrated into the car, including 14 cameras, short and long range radar, and a 120-degree solid state LiDAR system. So we'll be rolling that out to the world on October the 12th, preceding customer deliveries.
In order to get to where you need to get to in terms of your targets, how many people are you going to have to hire to do that?
Well, I mean, we're approaching 3,000 people in the company now. And actually, I always say I'd rather do more with less people. I always believe that it's my job to create a critical mass of intellect rather than just sheer mass of numbers. Give me less, more brilliant people to achieve that. But that said, undeniably, we're really growing our footprint here, particularly in Arizona, bringing in jobs into the state, great high-tech manufacturing jobs.
When are you going to be manufacturing in Saudi?
Well, we're looking at all options for plants, both in the Middle East and certainly in China mid-decade. So it would be absolutely great to have plants around the world as we move towards becoming a global player.
One more quick one, Peter. In terms of capital raise, you're doing a lot. How much money are you going to have to raise to do it, and when do you do it?
Right. So we raised 4.4 billion with the SPAC merger, including the PIPE. We had a healthy cash balance before that, and that sees us through into a healthy position right through to the end of 2022, to the end of next year. Now, clearly, that's before we bring Project Gravity into the plant here at the end of 23. So clearly, we're going to have to raise some more money, because this is a capital-intensive business, and we'll choose an opportune moment to do that.
I tell you what, Peter, there's a lot of people messaging in right now with a lot of questions. So people are very interested in what you're going to be delivering. I think the sequencing in terms of the rolling out of some of these things that you're going to be bringing to customers, I think is on top of everybody's mind right now. Peter, we're going to leave it there. Stock popping today. Peter Rawlinson, Lucid Motors CEO and Chief Technology Officer. We always appreciate your time. We're going to speak to another CEO of another automaker that's moving into the EV space, Torsten Müller-Ottvost of Rolls-Royce. They're going electric as well. We'll talk to him in the next hour. This is Bloomberg.
Live from New York, I'm Alix Steel. I'm with Guy Johnson over in London. This is Bloomberg Markets. So we're looking at S&P up by 0.6, up 1%. Dead cats are bouncing here. What about European markets? Here's Bloomberg's Ritika Gupta.
Yeah, Alex, a similar story here. We are seeing those dip buyers back here in Europe, but still not enough really for the Stock 600 to recover the losses that we've seen yesterday. We do really see the majority of the sectors in the green, though. As to what I'm looking at the semis. Now, they've been higher today, but we're actually seeing ASML now actually turning lower, but it was advancing just earlier in the session. They gave an upgraded sales forecast here, saying by 2025, they're going to have $35 billion of sales, and that gave a boost to some of its peers. ASM here, actually, the top performer in the Stock 600, up some 5%. Now, I'm also looking at the retailers like Next, for instance, here. This is really the barometer for the UK high street. Now, they also boosted their sales and profit guidance, so that has given a boost to some of those other retailers, the likes of JD Sports. Now, flip up the board as to what is moving to the downside is just a couple of sectors, but one that I'm looking at is the energy space here, Total Energies. That lower, that, of course, is oil. Brent is $78 a barrel, so a touch softer today. And I'm also looking, of course, at those utilities, the likes of E.ON and Enel down today as well as that crisis continues. And we just had that headline earlier that 3 more companies in the UK, those energy companies, will be going bust. Guy.
Yep, it's a story that is still ongoing. Gas prices continue to climb. Ritika Gupta, thank you very much indeed. So what have we got coming up for you in the European close? Because that's next. Winnie Cesar, Credit Insights Global Head of Strategy, joining us next. We'll carry on the conversation about these markets. This is Bloomberg.